Hello and welcome to this week's roundup of the currency markets with Vantage FX. This roundup is for information purposes only. It's not a recommendation to trade, so please speak to a financial advisor before making any investment decisions. While the events in Libya certainly had an impact on the markets last week, the Japanese yen and the Swiss franc were the main beneficiaries against the US dollar, with the Swiss franc reaching a record high against the US due to its safe haven status, and the yen recording its biggest weekly jump this year. Oil moved to a 29-month high, pushing above $100 a barrel, adding to global inflationary pressures. Indeed, it's inflation and the effect on interest rate expectation that's providing the main focus for this week. Turning to the Australian dollar, first of all. From a technical perspective, the Australian dollar has been remarkably resilient to the global tensions, and perhaps you would have expected to have seen the Aussie dollar to have lost ground in response due to risk aversion. But it's actually strengthened and approaching 102 against the US dollar. The high of 102.60 set on 31st of December last year is the next target on the upside if 102 is cleanly breached. On Tuesday we had the RBA interest rate meeting, and as expected there was no change and rates were left on hold at 4.75%. Whilst there was no change, inflationary pressures are very much on the RBA's radar right now. Commodity prices are rising, the rapid increase in oil prices due to tensions in Libya, as well as domestic wage inflationary pressures that are building. These are all very relevant, and the market expects the RBA to raise rates in the second half of this year. Retail sales figures for January and the current account balance for Q4 2010 were both released. Overall, the numbers came in mixed. The Australian retail sales figures for January were better than expected, up +0.4% compared to +0.3%. The current account balance for Q4 2010 came in slightly worse than expected, showing a 7.3 billion deficit rather than the 7 billion deficit expected. Later in the week, the market will be very closely watching the Q4 GDP figures that are released on Wednesday morning, and that will give an indication of the rate of growth of the economy during the last 3 months of 2010. Turning to the Eurozone, well, the euro has risen against the US dollar, driven mainly by interest rate expectation changes, with headline inflation hitting 2-year highs, and the futures markets are now pricing in the first rate rise by September this year. The ECB meet to discuss interest rates on March the 3rd, and rates are expected to remain at 1%, which is the same level they've been since May 2009. So with hawkish rhetoric from the ECB and a dovish Fed, it looks like it will be the ECB who moves first on interest rates. With the increase in oil prices, which are adding to inflationary pressures, the expectation is that the ECB is willing to react to those inflationary pressures more quickly than the Federal Reserve at the moment. So the direction of euro-dollar has been driven by central bank policy. Also, the euro has been the beneficiary of some of the outflow of the tensions in the Middle East. The US dollar hasn't reacted maybe as much as what we would have expected it to do so in light of its usual safe haven status. So where can euro-dollar go from here? Well, it's reached 138.40, its highest level since February the 2nd, easily pushing through resistance at the 137.50 level on the way. The next level on the upside is 138.60, which is the year high, and then the psychological level of 140 if the upward momentum remains. And then take it back right to November 2010 for the next level of 142.85. The combination of Eurozone rate hikes and a clear and viable solution to the Eurozone's debt crisis following the March summit on the 24th and 25th of this month, there is the potential for the euro to push higher, certainly through 140 and on towards the 150 level. However, I don't think the Eurozone's debt problems are over by a long way yet. Irish opposition parties have started coalition talks after their resounding election win has given them the mandate to renegotiate the terms of their bailout package. And Portuguese bond prices remain high, reflecting uncertainty around their financial status. Moving on to the UK, sterling had a poor end to last week and was pulled lower by the downward revision to the fourth quarter GDP, in which the UK economy shrank by 0.6% rather than the 0.5% that was expected. Sterling did fall initially, but since then the pound has recovered against most of its major trading partners, as the surge in oil prices keeps the pressure on the Bank of England to normalise their interest rate policy and raise rates from the current level of 0.5%. Consumer price growth moved higher to 4% in January and has been above the 2% target for 14 consecutive months now. Supported by the improved interest rate outlook, cable jumped from 161 to a high of 162.70 on Monday, and we are now approaching the high of the year. Not a huge amount of data releases for the UK this week. On Tuesday, there is the release of the nationwide house price index, which is expected to show a slight fall in house prices in February, and the manufacturing PMI, which will give an indication of the state of the country's manufacturing sector. Moving across to the US, a big week in terms of data releases for the US with the ISM manufacturing survey, the Fed's beige book, and the all-important non-farm payroll providing the key data this week. US consumer spending came in lower than expected for January, showing a modest 0.2% rise compared to the 0.4% forecast. Pending home sales were also lower than expected. For the non-farm payrolls, market expectation is for 183,000 jobs to have been created in February, and for the unemployment rate to come in at 9.1%. And that's released on Friday, so the market will be certainly paying a lot of attention to those numbers. Ending with China, China's manufacturing grew at a slower pace for the third month in reaction to 3 interest rate rises last year by the central bank in their attempt to control inflation. The Purchasing Managers Index fell to 52.2 in February, down from 52.9 in January. China's economic growth accelerated to a 9.8% annual pace in the fourth quarter, overtaking Japan as the world's second biggest economy. Consumer prices rose 4.9% in January compared to the government's target for the full year of 4%. That just about covers this week's look at the currency markets with Vantage FX. Please join me next week for another roundup.